All right.
Set
All right,
your
everyone.
setting.
How's everyone doing? I know we had a little Mardi Gras time last week, so hopefully everyone is recuperated and back to work and excited. So thank you for joining us today, 15 with Fallon. I will say last week we did have a couple people tell us that the chat was not working. We believe that we've gotten that fixed. So if you're seeing anything different, please let us know so we can make sure that the adjustment is made. But so let's get started. 15 with Fallon. What we do here is we do quick little 15-minute phone calls to make sure that we are staying up to date with what's happening in the real estate industry. We are learning, we are growing, whether it's marketing, loan programs, how to operate your business. We just want to give you small little doses, little tidbits of something to think about and learn throughout the week. So what we've been doing for the last couple of weeks, we've been going through the basics of different loan programs. So we covered the basics of FHA and how it relates to you as a real estate agent, the basics of the conventional loan. But today we are going to cover the highly anticipated USDA guaranteed loan. This, I will say, is probably the loan that we get the most questions about because there are a few different moving parts with this. And I would say that there's a little bit more gray area. So that's why it becomes a little bit more, I guess, I don't want to say complicated or complex, but there is a lot to learn about it. So what we need to talk about, okay, USDA, it stands for U.S. Department of Agriculture, and what they have is what's called a Rural Development Loan. Also, you may hear this referred to as an RD loan. Now, this loan type was created to build home ownership in the less populated areas. So the less densely populated areas around the country. This loan was developed to basically help people grow communities in that area. So what are the benefits? Why do people lean in the direction of USDA as opposed to other loan types? And I can tell you that the number one benefit of this loan type is the fact that it is a true 100% financing program. So it's 0% down. Now, this is not to be confused with a grant program or a down payment assistance program. This is a true 100% financing program. So that's huge because it allows buyers to be able to purchase a home without having to save up that 3.5%, 5% down payment that some of the other loan programs will require. So what are the other benefits to this? The other benefits are that it does have a lower rate. And when I say lower rate, it's very comparable to like an FHA interest rate. So that helps the borrowers as well. And it's got very low mortgage insurance, especially in comparison to FHA. And just a little side note here, there has been a change to the FHA mortgage insurance guidelines. So if you do go and check out the mortgage insurance video that we did a couple of weeks ago on the comparison of different mortgage insurances across these loan types, that has changed a bit. So I will put out I guess a statement or a note so that way you know that those numbers have come down for FHA. But back to USDA, very affordable mortgage insurance, which makes, again, home ownership more affordable for more people. Now, because it's a 0% down loan doesn't mean that closing costs aren't a factor. The buyer will still be responsible for the closing costs on the loan. However, there are a few different ways to kind of work this in. One of them is that USDA does allow for the seller to contribute up to 6% of the purchase price. So it's a great help to the buyer that's purchasing. If you cannot work this into the deal, USDA does allow for gifts, so you can get a gift from a relative. And what makes USDA a little bit unique is the fact that if you could possibly, possible is the word here, possibly finance in those closing costs, depending on how the appraisal comes back. So if that appraisal comes back higher, then sometimes you're able to finance in those closing costs instead of coming to the table with them up front, like we're used to doing with many of the other loan types. So just something to keep in mind. And so what I've said this a couple of times on a couple of different calls, but if you are working with a buyer or you have a potential buyer that's telling you, we really want to purchase, but we're just waiting to save up money, we're waiting to save up funds for the down payment, this is an option that you should talk to them about, get them in touch with me, get them in touch with a lender, because some buyers do not know that this is even possible. What I'm telling you is basically it is possible that a buyer can come to the closing table and purchase a house without having funds saved up. So that's huge. Now, and what we are seeing is right now we're seeing sellers actually negotiate a little bit. So it is easier at this point in time compared to, let's say, last year. It's easier at this point in time to, somewhat negotiate in some of those closing costs. So that's why I'm saying, don't wait. If you have someone who is on the fence, please speak with them, talk to them, because right now is the time to buy. Once those rates start coming down, it's going to cause more demand in the market for buyers, which means more competition, which means you're going to be in bidding wars and going over appraisal and a lot less likely to get help with those seller concessions. So, and I know I've said this before, and I know I've said it on a couple different calls, but I really want to reiterate it that way you understand, and you can also explain it to your buyers too, because we want to catch it while we can. You can always refinance the rate. You cannot renegotiate the deal. So just keep that in mind. So with all of these great benefits of the USDA loan, obviously there are some requirements and some restrictions. So you have to think about it this way. You're putting zero down. So the buyer does not really have a whole lot of skin in the game. So it does make it a little bit more risky for investors. However, there are the requirements that are put into place that help mediate some of those risks. And one of them is it only allow about a 45% maximum debt to income ratio. So what that means is however much money you have coming in as income, you're only able to, with the house note and with the debts that you have, go up to about 45%. In comparison to, let's say, the FHA loan that we discussed, that maximum is more like 56%. So you can see that's quite a bit of a gap. So if you are approved for more than one loan type, typically you'll probably be able to purchase a higher priced house with an FHA loan as compared to a USDA loan because of those DTI or debt to income limits. So that's one way, that they do kind of make sure that the house note is affordable, that you can, that the buyers can make the payments. So low DTI restrictions. Also, it must be a primary residence. So this is not a loan type that is for investment properties. This is for a primary residence. And unlike some of the other loan types that we spoke of, it does not allow for a non-occupying co-borrower. So if you have someone that is helping, maybe co-sign or be a co-borrower on the loan, you wouldn't be able to go this route because anyone on the loan would be required to live in the residence as a primary resident. So just something to keep in mind, especially when you're working with these buyers and you hear that, aunt or uncle is going to help them, but you see that they're looking at a 0% down or USDA loan. That's one of the red flags that you may want to, step up and say, okay, let's just get this checked out first, make sure that everyone's on the same page. The lender knows exactly what we're doing here. That way you don't get too far into the process and realize that it's something that's not possible. Okay. There are location restrictions with a USDA loan. And what we're going to do is I'm going to get Danielle. Danielle, if you don't mind putting the link to the USDA eligibility map in the chat there.
We need to set that setting.
Oh, let me do that right now.
And then I will put that in there.
Thank you so much for pointing that out.
It sounds like we need to do that at the beginning of every time. I think that's why we're.
Yes, I need to put that on the list of things to do. All right,
Yes.
let's see. Just got to figure out how to do that really quick, guys. Here we go. I'm going to put it in the chat. Here we go. And one more setting. All right, check that out. See if it's allowing you to put it in now.
Yep, there it is. Thank you.
Perfect. All right. That must have been the same that happened last time. Okay. All right. So this link right here, if you go to it, you'll be able to look up an address and see exactly if that address is eligible for a USDA loan or not. This is very important because if you're working with a buyer that says, I have to live in New Orleans, I have to live in the city of Lafayette, I have to live in Gulfport, you're going to be very limited because those three cities, typically when you're in the city limits, they do not qualify for rural development. So you're going to have to look outside of that city. So just bear that in mind, make sure that you're checking out these regions. So you're not wasting any time showing houses that are just not going to work for that particular loan program. Okay, so we talked about all this. Now, credit score. Credit score is always a question. USDA actually does not put a minimum credit score in the requirements. However, I will tell you that from dealing with a lot of USDA applicants, usually about a 620 or 640 or higher is where you're gonna be more approvable. Anything lower than that is going to probably ask for a lot of other positive compensating factors in order to get it approved. So you want to be at least in that range. If not, you may have some complications or some trouble, and they may ask for a lot of other pieces of documentation or a lot of other things that prove that you're able to consistently make payments on time. So that is what they say about credit score. Again, no minimum number, but most lenders also they have some type of overlay that puts what their minimum credit score is for a USDA loan. All right, now this is one of the big ones that gets very confusing. There is an income limit with a USDA loan. And when I say income limit, I mean not just whoever is on the loan, not just the borrower's income. USDA takes into account the entire household's income. So if grandma's living with you and she's got Social Security coming in, that's income. If you have a child that works, a teenager that works and makes money, that is income. They're going to want to know everyone in the household's income and add that together to make sure it does not go over the maximum allowed in order to qualify for this loan. So to give you an idea, in this area here, and these numbers are based on the area median income, it's based on living expenses, but here in a household of 4 or less, so if it's up to 4 people in a household, the maximum amount of income would be $103,500 right now here. Now, if you have 5 people in the house or more, that maximum does increase a bit, but that's just to kind of give you an idea. Now, this is something that you're going to probably run into. So I'm sure that when you're showing houses, you're probably showing the whole family, grandma, uncle, everybody that's going to live there is probably coming on these showings with you. So if you see that that's the case, just make sure that it's mentioned, because again, you don't want to get closer to closing and go through the entire offer and through the entire inspection and all of that, just to find out that there may be too many incomes in the household where it might knock them out of qualifying for a USDA loan. So just something to think about. Now, also let me make note to not confuse the qualification income limits with the DTI. For debt to income purposes, they're only going to take the income of the borrower into account. So whoever's name is on the loan, that's the person whose income they're going to use to determine the debt to income ratio. So it's two different things. Hopefully I've made some sense of that. If you do have any questions, let me know, and I try to really break that down so you can see the difference of when you're using households and when you're using the borrower's income for calculation purposes. And then last but not least, with a USDA loan, the condition of the house is also very important. USDA does follow the FHA guidelines as far as, what is acceptable. So if you're showing a house and you see peeling paint, if you see unfinished flooring, if you see exposed wires, broken windows, these type of things, let that be something that you red flag and you make sure it is taken care of before the appraiser goes out there, because all the appraiser is going to do on a USDA loan is they're going to see those things, they're going to flag them, and they're going to have someone mitigate the issues, repair, replace, do that before they have to go out again for an approval. So you don't want to waste time and money. So if you see these things, just make sure that they're addressed whenever possible ahead of time. So that's the basics of the USDA loan. I know that, again, there are some moving parts with this. There are some more restrictions. They're taking into account, other people besides the borrowers for guideline purposes. So when you are working with someone that is approved for a USDA loan or is looking to get approved for a USDA loan, you want to make sure that, if you can stay involved in that process and speak with the lender and make sure they've taken all of these things into account, that could possibly save a lot of headache and a lot of time for you. So Danielle, are there any questions in the chat?
I have a couple of quick questions.
Okay.
One is total household 4 people or less. Is that people earning income, or is that people in the house, even like a 2-year-old?
Okay, so that's a very good question. That is people in the house. So if you have a 2-year-old, a 5-year-old, and spouses, that would be 4 people. But they would only, for the household income, they would take whoever in that household is making money. So in this particular case, it may be mom and dad making the money. So the amount of people puts you in at certain restriction level, but the actual people who are bringing in income is what is taken into account for the qualification to make sure they're not over the maximum. Does that make sense?
Yep. And then the last question is, since we're in Louisiana, how does spousal debts play into this, since we're community property?
Okay, so great question. So we've talked about for an FHA loan, even if the spouse is not on the loan, because Louisiana and Texas are community property states, we still have to take the spouse's debt into account whenever we're calculating DTI. Now, Mississippi is a different story. Mississippi is not a community property state. The USDA loan, because it is also a government loan, is going to be the same exact premise. We are going to have to take the spousal debt into account, even if the spouse is not on the loan in Texas and Mississippi. Texas and Louisiana, not Mississippi.
All right, I think that's it.
All right, excellent. Well, hopefully this gives you a little bit of an idea of what to look out for. Again, we are going to have a chart that we put out that it just breaks it down, a quick, easy reference sheet, so you can refer to these different loan types and say, okay, oh, here, this is a restriction for this loan type. This is not a restriction for that loan type. So we will be putting that together. On the next call, we'll be covering VA loans. So if that is something that you're interested in, VA loans do have a little bit of they have some different guidelines. So we want to make sure that we point those out as well. So join us next time. Let me know if you have any questions. As always, we want to hear from you. If there are certain topics that you want us to cover, please let us know. We'd love to make sure that we put that on the schedule and we get a call done for that. So, all right, I hope you'll have a fantastic week and I will talk to you soon. Bye-bye.
Bye.